middle of a major move, there's going to be a midpoint. And it doesn't have to be a perfect midpoint in time or a perfect midpoint on the price move. If you get what I mean, it's not exactly halfway up. But there's a point of violence where you shake people out. It's very rare to go from A to Z without a shakeout because that means everybody's happy all the way up, right? And normally markets will cleanse themselves of especially latecomers. By latecomers, I mean on silver, we had about 3 major buy signals based on long-term momentum of silver over the last couple of years. One was in March of 2024. At that point, silver was $26. The other one was in June of 2025. Silver then was just below 35. And our last buy signal was the close of November of last year. Silver was $56. And we quit at that point in terms of suggesting you initiate major long positions. If you do after that, fine, but it's not an optimal point of entry. And we obviously, when silver took out the top of the range, that 50-year lateral confined range at $50, people started then and only then to wake up. And a lot of them didn't act right away. And, it was probably $90 or $100 before they finally said, well, I better buy some silver, or gold. And they were latecomers, and therefore they got gut kicked. But this almost always happens in any dynamic market, and you just have to expect it. We were expecting it to happen. It just came a little earlier than we thought. We thought it'd be more like February, March, that you'd reach some kind of trading peak to create, a violent congestion zone. And it occurred instead of the last day of January. In fact, in one day, almost the whole move occurred in one day, if you look at your charts. But anyway, that's where I think we are, is that both gold and silver have been rattling around. And instead of looking, again, we look at momentum and structures of momentum trends, okay? But the average guy, when you punch up your screen and look at a gold chart, don't look at it daily. Punch up a monthly bar chart and of silver or gold, monthly. We're only looking single bars. So there's like 3 months. There's the January break, and then there was Feb, March, April. Sideways. Terrifying rallies, collapses, but net on balance, you could draw a line through about the middle of that ink, and you would just go on either side of it. I know everybody thought it was the top, and I'm sure the bears thought, oh boy, I'm going to make a ton of money. Silver's going back to $50 or whatever. Well, anyway, we think it's about to come out of here, the congestion zone. And we think that using our momentum metrics, tell us that we probably have just seen the final downside effort. And that was if you recall, in late March, silver and gold did the nasty thing of actually going down in price and nipping out the February price low, which was a sharp low. They went down there and they nipped it out, which we thought would happen. And within hours, they were exploding back to the upside. In other words, they went down there and ran some sell stops, spooked the latecomers, and goes, it's no good, and then right back up again into the range. So anyway, we think it's about to resume in a very strong way. And a lot of what we're going to see, I think, will occur by summer, some point during this summer.
What do you think is going to occur?
I think silver still is going to $300 to $500, $300 to $500. And I know people will laugh at that. In fact, we were arguing back 2 years ago that we were going to probably run up to $90 plus at some point this past year. And we got laughed at for that. But I actually think there's a variety of various reasons to justify silver going to that kind of price level. And, we've explained that to our subscribers in layers of the arguments. Some of them are technical, price technical. Most of them are minimum based, but some of them are just monetary valuation based. Like, take, for example, if silver hit 50 in 1980, where was the money supply then? M2. You get an M2 chart from the Fed. You can look, you can punch one up, go back and see where it was and see how much it's grown since. It's incredible. It's parabolic. And or you go back to 2011. That's when silver again went up to the top of that that capped off range at 50. It got bagged again. So you had 2 times you went to 50, but the money growth just continues and continues. And if you look at other markets like gold, the mama market of the monetary metals. Silver's the little baby, but it's still a monetary metal. It's been one for 3,000 years, just like gold has. But gold hasn't been stopped by prior highs. Its 1980 peak was not confinement for gold in 2011. It blew the heck, it doubled it, or now. It keeps making higher highs, yet silver was capped. Highly unusual. It fits with, the argument made by many that, somebodies have been trying to keep this market suppressed. Or you can look at a copper chart and you go back to 1970s, 1980s, 90s, 2000 through about late 2005. Copper was in a little Deadsville range of 50 cents to $1.50 a pound, 50 cents to $1.50 for decades. Just like, boring. In late 2005, it finally punched through the top of that price range. And it did it on its own. It didn't do it because gold was exploding and silver was, everything was exploding. It did it on its own. And it quadrupled in price in a matter of a couple quarters, and then lived in a new reality between $3.50 and $4, $4.50. Instead of 50 cents to $1.50. But the move from one to the other wasn't gradual, let's be cautious type rally. It was explosive. And, if you didn't catch it, you didn't catch it. And of course, now copper's even making a higher high, $6. But, why was silver contained? Gold wasn't, copper wasn't, lead wasn't. But silver was contained. I think there's something else going on here. And it's far bigger than it's the monetary metals reason for going up. It's not because of this, that, or other news story that people like to always attach to gold, and they get smacked in the face when they do. Like, for instance, recently, if you thought, war in Iran, that's bullish for gold because it's global uncertainty. That's not what drives gold. What drives gold ultimately is the ongoing decay and ultimately collapse in the real value of fiat monies, not just ours, but the yen, the euro, all of them, in constant decay in real value. So when you look at an M2 chart, and it basically every decade it gains 80% from where it was the decade before. That's why when you were your granddad built a house, the average cost was $4,500. Your dad built one; it was $45,000. Now the mean price of a home is $450,000. It's reflecting what? The ongoing decay in the money unit. Silver's been lagged to that of late for whatever reasons. Gold has to some extent not, because it keeps making higher highs over the past 50 years. Silver's in a catch-up. And I think once you get up there, certain things are going to happen other than just silver and gold advancing. In particular, I think the stock market is in a topping process. I say process, because the stock market rarely just peaks and collapses. You go back and look at the 2000 top or the 2011 top, the 2007 top. It's laborious, spanned a year, this topping type action, and before it finally fell apart ultimately, sometimes with a crash and sometimes not. 2000 to 2002 there never was really a crash. It was just a bloody decline. I think that's about to occur, which means what? Well, it means that people who have money in that category have to figure out a place for it to go other than there, unless they just want to put it in cash. And a lot of money managers, I can tell by the action of gold, for example, have already begun that move into the monetary metals. That happened last October. Gold broke out of a spread relationship to the S&P. It had been in a 10-year wide basing pattern, and gold popped through the top of that range on the relative performance readings and has surged since, meaning I'm the category that beats that category, okay? Now, the more that becomes obvious to the average investor, the more pain they feel from their portfolio suddenly dropping 30%. They're going to put it somewhere. They always do. And gold is almost always a prime beneficiary. But then this time around, we got something different. And we've been talking about it for over a year or so. And that is the U.S. government debt market, bond market. We already know the Japanese bond market's in crisis mode. It has been for some months now. In fact, that new prime minister, who I think got elected about a year ago, she said, we're going to print to defend that piece of paper. Okay, well, they've been doing that. And as if that'll help it, that just destroys the value of the money unit in terms of its buying power ultimately, but that's their measure, that's their metric. And we'll do the same thing. Have no doubt that the central bank will do what it has to do to defend the U.S. bond market. because U.S. T-bond market, I'm talking the long end of the debt market, 30-year bonds. If you look at the price chart, T-bonds crashed effectively. We got bearish in 2020. Price of T-bond futures then was at the 190, 180 area, 180, not yield, I'm talking price now, which is the opposite of yield. You crashed down to 117 and a half in October of 2022. So for about a year and a half, there was this huge collapse in bonds, rise in yields. But since then, 23, 24, 25, now into 26, it's lateral. Yields are high. They won't top out. Price is suppressed, depressed. It can't seem to get a rally going. So, the Morgan Stanley CIO about 6 months ago, I think, said, the old notion of 60% stocks, 40% bond portfolio allocation concept is invalid. It should now be 60, 20, 20. There's a modest change, but the 20% is gold, not just T-bonds. He was recognizing that the T-bond market's not behaving as an alternative. And while the stocks have rallied despite the war continuing, after that false sell-off based on the war, you don't sell stocks based on transient news.